We will now talk about a little bit about the overview of accounting standards in India, how they started and at what stage we are in at present. As we know, Institute of Chartered Accountants of India is the body interested with the preparation of accounting standards in India. They constituted an accounting standards board called the ASB on 21st April 1977. That means it started almost about 35 years back. The main function of accounting standards board, that is ASB, is to formulate accounting standard so that such standards may be established in India by the Council of the Accounting, by the Institute of Chartered Accountants of India. So we have now many accounting standards which have been issued. Presently there are 32 accounting standards issued by the Institute of Chartered Accountants of India and ratified by the Government of India, and these are the important accounting standards. AS1 deals with disclosure of accounting policies, AS2 deals with valuation of inventories, AS3 deals with cash flow statements, AS4 deals with contingencies and events occurring after the balance sheet date, AS5 deals with net profit or loss for the periods, prior period items and changes in accounting policies, AS6 deals with depreciation accounting, AS7 deals with construction contracts, AS9 deals with revenue recognition. Here we find that AS8 is missing, that means it has been withdrawn. There is no standard called AS8 now. And AS10 deals with accounting for fixed assets, that means whatever fixed assets are taken by the entities, they are accounted for in the way detailed in AS10. Then AS11 deals with effects of changes in foreign exchange rates. This becomes useful whenever an entity has got assets and liabilities in foreign currencies. Then AS12 is accounting for government grants, those entities which get government grants either in the form of grants for capital expenditure or for other purposes. Then AS13 deals with accounting for investments. AS14 is accounting for amalgamations, that is mergers and amalgamations. AS15 is employee benefits such as provident fund, leave encashment, gratuity, etc. AS16 is for borrowing costs. AS17 is for segment reporting. AS18 is for related party disclosure. This is one of the most important accounting standards. Related party here means parties which are related to the management or to the promoters or to the shareholders. And AS19 talks about lease. AS20 is earnings per share, normally known as EPS. AS21 is consolidated financial statements. That means this is applicable in the case of those entities which have got subsidiaries and they need to consolidate the financial statements of the subsidiaries with the parent company. And AS22 is accounting for taxes on income. That means whatever income tax is payable, how it is to be accounted for in the books of the entity. AS13 is for accounting for investments in associates in consolidated financial statements. Whenever a parent company or a holding company makes investments in the associate companies, how that is to be accounted for in the financial statement of the entity itself when they are consolidating the entire financial statements. Then AS24 is for discontinuing operations. In the case an entity decides to discontinue certain operations, how those financial statements have to be prepared is given in AS24. And AS25 is interim financial reporting. Normally this happens in the case of those listed entities which are listed on the stock exchanges to come out with interim financial reports. They are required to have every quarter financial data to be published in the newspapers, and AS25 deals with as how it is to be done, what is the information which needs to be given. AS26 deals with intangible assets. AS27 deals with financial reporting of interests in joint ventures. Then AS28 is impairment of assets. Whenever assets are impaired, there we need to account for them in a certain specific manner. AS29 is provisions, contingent liabilities and contingent assets. All these are covered under AS29. AS30 is financial instruments, recognition and measurement. These days, there are a lot of novel financial instruments which have come to the market, particularly in the form of financial derivatives. So, this accounting standard talks of as to how to recognize and measure these financial instruments, and AS 31 talks of as to how to present these financial instruments in the balance sheet and the profit and loss account. AS 32 deals with the disclosure of these financial statements. That means AS 30, 31 and 32 all deal with financial instruments. Now let us try to understand the salient features of each of these accounting standards. We need not go into the details. It is sufficient if you know as to what is the purpose of this particular accounting standard and what are the salient features of these accounting standards and how they have to be implemented. So let us start with the first accounting standard known as disclosure of accounting policies, AS1. This, as the name suggests, deals with the presentation and disclosure requirements of the significant accounting policies followed in the preparation of financial statements. As we know, each entity is allowed to follow different accounting policies in order to suit its own needs, and in respect of which the choice is given to the entity. But this accounting standard says that it is mandatory for all entities to disclose whatever accounting policies have been used in the preparation of financial statements. So, what is the meaning of significant accounting policies? These are the specific accounting policies and methods of applying those principles. As we know, accounting policies can be in the matter of conversion of foreign currency transactions into home currency, or it could be in the matter of valuation of inventories, it could be in the matter of valuation of investment, it could be in the matter of adopting a particular method for computing depreciation, etc. So, all these significant accounting policies need to be disclosed in a particular manner. The true and fair state of affairs and the financial results of an entity are significantly affected by the accounting policies adopted. So, as you know, if you change the accounting policies, the results will change. So, in order to ensure that the entities are in a position to give a true and fair position of the financial statement, it is necessary that they follow accounting policies in a consistent manner, and not only that, they disclose what policies they have been following. So, as I have already said, the areas in which accounting policies can be followed depend on such areas such as depreciation, valuation of inventories, valuation of fixed assets, etc. And this disclosure requirement has to be such that the disclosures are to be given as part of the financial statements. And one more important significant thing in this accounting standard is that whenever there is a change in the accounting policy adopted by the entity, that has to be separately disclosed. That means, for example, let us say a company changes its method of valuation of inventory, or it changes its method of computation of depreciation. That change has to be disclosed prominently in the financial statements. Not only that, after the change, what effect it will have on the balance sheet, that also needs to be disclosed. Not only the change which will happen in the financial statement of the entity of that particular year, but also what effect it may have in future also needs to be disclosed. And it also says that wherever necessary, these changes need to be quantified. Only when it is not possible to quantify, you can say that it is not possible to quantify, but wherever it is possible to quantify, that has to be stated. For example, let us say if the company has changed its method of depreciation from WDV to straight line method, this will, as you know, naturally affect the profit and loss of the entity. So, if the entity has changed the method of depreciation, then they will have to quantify what is the effect in the profit and loss. That means that has to be quantified. They have to state that the profit of the entity would have been so much more had they continued to follow the old system of depreciation, and they also quantify that in future also this will be different. So, this kind of quantification also becomes necessary. This is stated. And finally, this accounting standard states that three fundamental accounting assumptions which we considered in the earlier discussion, they need not be disclosed at all. That means if an entity is following these assumptions, that is the going concern, consistency and accrual, then they need not disclose it, because they are said to be there by default. Only if an entity does not follow any of these accounting assumptions, then they have to clearly disclose this, otherwise they need not disclose. This is regarding the first accounting standard, that is disclosure of accounting policies. And accounting standard 2 deals with valuation of inventories. As you know, inventories are normally the stocks carried on by the entity. In the case of a manufacturing company, inventory will consist of raw materials, stocks in process or semi-finished goods and finished goods. In the case of a trading company, there will only be stocks, which include consumables, spares and stores. So all these need to be valued at the end of the year, so that this information is incorporated in the profit and loss account as also in the balance sheet. Any change in the value of the inventory will affect the profit and loss of the company and also affect the balance sheet position. So therefore, the basis on which these are valued is very important, and there are different methods which are used in valuation of these inventories, and the accounting standard 2 has narrowed down these methods to only 2 methods. What it says is that these have to be valued on the basis of either FIFO method or the weighted average cost formula. What the FIFO method says is that first in first out, that means it has to be based on the principle that whatever inventory has been bought into the entity first is assumed to have been used first, and what remains at the end of the year is the inventory bought last. So on that basis they have to value the inventory. In the case of weighted average cost formula, they will be taking the weighted average cost of the various purchases made in respect of inventories, and that will be used. All other methods of valuing inventory are not permitted in terms of AS2. So as we have seen here, the standard dispenses with the direct costing methods and permits only the absorption costing method for arriving at the cost of finished goods. That means they cannot use any other method other than the absorption costing method. All other direct methods have to be dispensed with. Now we go to the third accounting standard, that is AS3 in respect of cash flow statements. As we know, cash flow statement is an important part of the financial statement of an entity. So here cash flow statement accounting standard states that the cash flow statement has to be prepared in a particular manner. So this accounting standard deals with the provision of information about the historical changes in cash and cash equivalents of an enterprise by means of cash flow statements. That means whatever changes have been brought about in the matter of cash and cash equivalents. So what is the meaning of cash and cash equivalents? Cash, of course you know, includes cash and bank balances. Cash equivalents are those assets of the entity which are convertible into cash quickly without much loss of value of the assets. So all these are treated as cash equivalents. They are as good as cash. Therefore, an entity is required to find out as to what changes have happened in the cash and cash equivalents. The cash flows are classified into 3 kinds of activities. One is the operating activities, second is the investing activities, third is the financing activities. As I was saying, operating activities relate to the actual business of the entity. For example, if it is a manufacturing concern, anything related with the manufacture of the product, sale of the product is treated as a operating activity. In the case of a bank, the operating activity naturally is the acceptance of deposits, lending of money, remittance of funds, etc. These are the normal activities of the bank. So they are classified into operating activities. Investing activities basically refer to investment of funds in fixed assets by the company or sale of second hand fixed assets, all are treated as investing activities, and in the case of financing activities they relate to acquiring funds for the business, that is borrowing funds from banks, financial institutions outside, or repayment of these funds. They are all treated as financing activities. For example, interest paid on borrowings is part of the financing activity, or a cash credit taken from a bank is treated as a financing activity. So, what is the reason for classification of these activities into different kinds of activities? The basic objective is to know as to what kind of cash flows are generated from the main activity of the entity, that is the operating activity. Is there a surplus of cash flows? That means the net cash inflows are there or not in respect of operating activities, and if so, how are these ultimately being utilized by the company, by the entity, that is known. And if there is a shortfall in the operating activities, how the shortfall is being met, this is given in the cash flow statement. So, what it says is, cash flow statement helps in assessing the ability of an enterprise to generate cash and cash equivalents, and enables users to develop models to assess and compare the present value of future cash flows of different enterprises. The basic objective here is to enable the users of the financial statement as to find out as to how much cash the company or the entity is likely to generate in future, because that future generation of cash flows is what an investor or an user of financial statement is interested in. The higher the generation of cash flows in future, higher will be the value of the share of the company. So, this gives them an idea as to in what direction the entity is moving. Therefore, cash flow statement becomes an important tool for the users of financial statement to assess the position of the entity. The cash flow statement presentation also has been laid down in the accounting standard 3 as to how the cash flow statement needs to be presented. So, this kind of presentation will help the management to improve the cash flows rather than profits. As we know, profits are different from cash flows, because profits involve certain entries which may not involve inflow or outflow of cash. For example, depreciation is only a book entry, it will reduce the profit, whereas there is no outflow of cash. So, the cash generated will be much more than what the profits indicate, or in certain cases there need not be any cash inflow, though it has been taken as income. For example, all sales done on credit will be treated as sales, as income, but will not be resulting in any cash inflow. Therefore, the profit will be different from the cash flows. So, this cash flow statement will give us an idea as to what is the net inflow of cash into the entity and how the cash flows are being utilized by the entity to achieve the objectives of that particular entity. Now, we will go to the fourth accounting standard known as the contingencies and events occurring after the balance sheet date. So, there are two parts here. One is contingencies, second is those events which occur after the date of the balance sheet date. For example, after the balance sheet date of 31st March of an year is over, normally there is a time lag between the date of the balance sheet and the date when the balance sheet is adopted by the board of directors of the entity. So, what happens during that period may also have a bearing on the entity. Therefore, this needs to be disclosed. So, to start with, regarding the contingencies, the institute has issued another accounting standard known as AS 29 called provisions contingent liabilities and contingent assets. So, therefore, anything contained in this accounting standard 4 in relation to contingencies has been withdrawn. Therefore, the present accounting standard 4 deals only with the treatment and disclosure of events occurring after the balance sheet date. That means, this accounting standard mainly deals with events occurring after the date of the balance sheet. So, what are these events which occur after the balance sheet date? They are not the normal events which may happen in the entities. They are the significant events, whether they are favorable to the entity or unfavorable to the entity, that occur between the balance sheet date and the date on which the financial statements are approved by the approving authority of an entity. Who is the approving authority? In the case of a company, it is the board of directors of the entity when they are approved by the board of directors, or in the case of a partnership firm when it is adopted by the partners, or in the case of a proprietary firm when it is accepted by the proprietor. So, during that period anything may happen, and these need to be disclosed because these need to be made known to the users of the financial statement. For example, let us say a company has closed its balance sheet as on 31st March 2011, and the balance sheet is actually accepted, let us say, in the month of May. So, in between 31st March and the month of May, there could be some fire which has destroyed the entire assets of the entity. This is a significant event because this event has a significant bearing on the working of the entity, isn't it? Therefore, it is necessary that this has to be disclosed in the balance sheet as part of a disclosure, so that the users of the financial statement will know as to whether this event is going to have a favorable or an unfavorable impact on the working of the entity. Now, let us go to accounting standard 5. It deals with net profit or loss for the periods, prior period items and changes in accounting policy. So, there are three parts here. One is net profit or loss for the period, that is for the period under question. Then the prior period item, that means those items of income or expenditure which do not relate to the present period, that is the present accounting year, but may relate to either previous years or future years, or any changes which may have happened in the accounting policies used in the preparation of the financial statements. Prior period items, as we know, are income or expenses which arise in the current period as a result of errors and omissions in the preparation of financial statement of one or more prior periods. That means basically they refer to prior period items. So, but they are being reflected in the financial statement of the current year. Why they need to be disclosed separately? Because they do not relate to this period, and the objective of the financial statement is to give an idea as to what the performance of the entity during that accounting period and what is the financial position of the accounting of the entity as at the end of that particular accounting period. So, in order to ensure that they reflect only those events and transactions which relate to that accounting period, we need to segregate what is not related to that accounting period, and they have to be shown separately, so that the users of the financial statement will be in a position to distinguish between those events and the events related to the accounting period. Similarly, they also have to remove the extraordinary items which may have gone into the preparation of the financial statement, and they have to be shown separately. What are these extraordinary events or items? These are the income expenses that arise from events or transactions that are clearly distinct from the ordinary activities of the enterprise and therefore are not expected to recur frequently or regularly. For example, let us say the entity has sold a part of the land at a very huge profit, resulting in a high profit during the accounting period, but it is not a normal activity of the entity. So, the profit of the current period includes profit from the sale of this land, and this is an activity which is not ordinary. That means it is an extraordinary activity, and it is not expected that the company will be selling these lands on a regular basis, because company is not in the business of selling or buying lands. This is a one time activity. Therefore, this has to be segregated in order to know as to what is the profit of the entity after taking out this extraordinary profit which the entity has generated. Therefore, it is necessary to segregate extraordinary items also, so that the users of the financial statement are in a position to know what is the normal profit of the entity after deducting all such extraordinary items or expenses. Even expenses also may distort the profit and loss position of the entity. The prior period and extraordinary items are required to be disclosed in the profit and loss statements as part of the net profit for the period with separate disclosure of the nature and amount to show its impact on current profit or loss. So, the disclosure also has to be showed separately, so that we know what is the extent of the extraordinary items and what is the extent of prior period items, as also what is the extent of their effect on the profit and loss of the current year or the current accounting period. Now, we will go to AS 6. This is called depreciation accounting. As we know, depreciation also has to be accounted for in the books of the entity in order to ensure that the profit and loss reflects a fair and true position of the happening in the entity. And as we also know that there are different methods of computing depreciation. So, the standard tries to restrict the different methods of computation of depreciation to certain methods, and also states as to what should be the disclosures required to be made in the event of a change in the method of computing depreciation. So, this method mainly deals with as to what is the method to be used and what happens when there is a change in the method of depreciation. So, as we know, what the accounting standard says is that the depreciable amount of a depreciable asset should be allocated on a systematic basis to each accounting period during the useful life of the asset. What basically this means is, whenever there is a depreciable asset, the quantity which is required to be deducted from the depreciable asset has to be allocated for each accounting period depending on the total useful life of the asset. For example, if there is a machinery and if the useful life of the machinery is 5 years, the value of the machinery which is accounted for in the books of the company has to be allocated in those 5 years. That means it has to be distributed in these 5 years on a particular basis. And what is this basis? This basis is on the method being employed by the entity in calculation of depreciation. Therefore, the depreciation method selected should be applied consistently from period to period. What it means is, if an entity is following a particular method of depreciation, it has to continue to follow the same method from year to year. That means there should be some consistency in the use of the different methods. If for some reason the company wants to change the method of depreciation, then it is permitted as per the accounting standard. So, whenever there is a change in the method of depreciation, it is treated as a change in the accounting policy, and therefore, as we have seen in AS 1, that is accounting standard 1, whenever there is a change in accounting policy, it has to be disclosed in the financial statement. That means there should be a disclosure as to the change in the method of depreciation. Not only that, we have to also quantify the effect of such change on the financial statements of the company. That means quantification also becomes very important. So, both the amount that the change would make in the balance sheet of the company also has to be disclosed. In case you are disposing of a depreciable asset, or it is discarded or demolished, the net surplus deficiency should be disclosed separately. For example, if a company has sold off the building, they would be getting some money out of that sale of building. So, this is disposal of a depreciable asset, and this money has to be shown separately, so that the users of the financial statement know that this cash flow has come from activities other than the normal activities of the entity. The depreciation method used and the depreciation rates are also required to be disclosed in the financial statements. So, it says that if the entity is using the WDV method, you have to state that the entity is using the WDV method, and also the different depreciation rates which they are applying also have to be indicated. For example, if they are applying, let us say, 10% rate of depreciation on furniture and fixtures, this also needs to be disclosed in the financial statements.